The Fed wasn't the only central bank to impact the markets today. Policymakers at the Bank of Japan decided to try something different. Instead of printing more money to stoke inflation, it is targeting interest rates on government bonds. Akiko Fujita has more on the importance of this policy shift from Tokyo.
We saw the markets rally on initial reports of this decision and the introduction of this yield curve control, the Nikkei gaining more than 300 points at the close. But a closer look at this policy framework and the comprehensive assessment shows this is really about tweaking an existing policy. The BOJ looking for a little more flexibility, looking to buy a little more time to reach that 2% inflation target. You could certainly argue this was a letdown for the markets. Investors were looking for a further rate cut into negative territory. And you could also say this is in part an admission from the BOJ on defeat on its existing policies, although Governor Kuroda today in his press conference said this new shift towards the yield curve control was really about bolstering the foundation laid by the policies BOJ has already put forward. Take a listen.
The new framework, which centers around a yield curve control, will be more flexible to prices and financial conditions compared to the original methods of controlling the growth of monetary base and outstanding government bonds.
That curve control means the BOJ is abandoning their monetary base to buy a longer-term government bonds to keep 10-year yields near zero and steepen the curve. BOJ also committing to overshoot inflation, essentially committing to continued expansion of its monetary base until they can reach core CPI at 2% target and stay above that target in a stable manner. We did see the yen weaken on the back of this decision, reaching that 102 level, but there's little confidence here in Japan it can maintain that level with so many external factors weighing on the currency. For Nightly Business Report, I'm Akiko Fujita in Tokyo.